Okay, hi everyone. My name is Richard Perry and I am the market analyst at Handtech Markets, and this is my latest webinar that I'm holding for FX Street. Today we're going to be talking about central banks and basically the fact that they're going to be driving markets throughout September, I think. Obviously, first of all, we're looking out for the ECB, but then subsequently we've got the Bank of England, the Fed, and the Bank of Japan as well coming up in the next few weeks. So lots going on, lots to talk about. So I'll just get into it quickly. Now, before I, sorry, I should have been looking at my webcam then. Before I get into it, I'm just going to sort of now show you my slides. So just please, everyone check that you can see my slides that I'm hopefully showing you now. And right, and getting into this sort of main topic is really how dovish is the ECB going to be and how dovish is it going to be able to come across. Now, before I get into it, disclaimer time. The disclaimer is obviously important because I'm going to be talking about live market information, so please read and understand that. I will show it to you at the end of the presentation as well. Again, what we're going to be talking about, so basically the sort of fallout from non-farm payrolls, how that impacts on the Fed, looking ahead also to the ECB and other central bank decisions, and other key economic events to watch in the coming days. What impact will they have on the markets? And going to be doing a live market analysis. So if anyone has any sort of instruments that they want me to look at, please give me a shout and I will be more than happy to help you out. But I'm going to be sort of focusing mainly on forex majors, indices, and commodities. Right, sort of starting with the payrolls, really. Obviously, non-farm payrolls on Friday was a bit of a disappointment, but I think more importantly, it sort of came along a bit of a string of disappointing data, really, that we've had in the last few days that pretty much now just I think puts a nail in the coffin for September as in terms of a rate hike. We had the September Fed funds futures up around sort of 30-odd% previous to the data in the last few days. That has now dropped significantly. Yesterday's ISM non-manufacturing PMI was the latest, really to sort of put to bed, I think, that, because I think non-manufacturing PMI, the service sector, sort of, well, consumer spending is around 70-odd% of the economy, and service sector is a pretty sizable aspect there for the Fed to be looking at. And if the service sector is coming in pretty tepid, then the Fed is going to be struggling to hike rates, I think. As you can see here, I've sort of listed out the data that we've had in the last few days. Sorry, in recent times, and you can see that in terms of the positives, there aren't that many, and in terms of sort of June, July payrolls, that's obviously been subsequently followed up by a pretty mixed or tepid August payrolls data. So in terms of the negatives, you'd sort of look at the retail sales data. That was minus 0.3 months on month. That was again a disappointment, year on year, falling to a 2016 low. The ISM manufacturing data, 49.6. Yesterday's non-manufacturing ISM was down also 51. I think it's 51.4. Is that right? 51.9, one of the two. And that was again the lowest you've had in sort of 6 years. On that data, so it really does show that the Fed is, the US economy is slowing down, and that run rate is pretty low now, I think, in terms of growth going forward for the US economy. It's around about 1%, I do believe, for if that is to be extrapolated through. So it's not great in terms of economic growth going forward, and you could question whether the Fed can sort of hike in that environment. You've also got the regional Fed surveys, which are pretty much all showing below trend growth. New York, Kansas, Dallas, all below zero. Richmond was the lowest since January 2013, and it was only really the Philly Fed that was mildly positive, but certainly there is problems there. And productivity fell in Q2. Again, we've had 3 quarters of consecutive productivity declines now in the States. And again, that's not great. You've had payrolls which are falling away. I was sort of listening to a podcast yesterday, and they were saying that the jobs growth in the States is significantly to do with sort of bar staff and waiting staff. And it's the argument being that it's the manufacturing jobs have fallen off, and the manufacturing jobs are the really productive ones, whereas sort of bar staff, waiting staff are basically just people taking on more jobs, because you've got the number of hours worked falling away, and instead of sort of just having one job, now people or bar staff and restaurant waiters are sort of taking on more than one job, and that's not ultimately all that positive for the economy if you sort of think about the fact that we're losing, or the States is losing, manufacturing jobs. So that's not all that great for growth going forward. And in terms of your pretty tepid data, you've had August payrolls, inflation again 1.6% on the core PCE, not really moving. Growth again, the indicators for Q1, Q2 have been weak. Q3 is running a little bit better, but certainly at the moment the PMIs are not great, and consumer indicators have been mixed as well. So we've had that impacting through the expectations for rate hikes. I'm still going for December personally. I think the Fed will move in December after the presidential election. But again, I think it's going to be very, very slow to hike rates in the future. And I think the path of the interest rate tightening cycle is going to be very, very, very shallow. And subsequently, I think you're not going to get any sustained dollar strength. I think the dollar might tick up towards the end of the year as the Fed sort of moves towards a tightening. And again, I think it is likely to be December still, but I think the Fed is going to tighten through gritted teeth, because I don't think the economic data, generally speaking, going forward is all that great. I think the Fed is again sort of in a position in which it pretty much has to tighten at some stage, and it's going to do it through gritted teeth, very, very nominally, in terms of a very small interest rate hike, and just to sort of show it's doing something. But ultimately, I think the Fed is really still quite dovish, in my opinion. So in sort of its conclusion, really, I don't think we're going to get a September rate hike, and I don't think therefore the dollar is going to be strengthening anytime soon. I think we're going to see some choppy moves on the data, but ultimately I think December is still likely to be seen, in my opinion. Now, the coming days, well, we've got our first rate hike, our first monetary policy decision today. Got the Bank of Canada. No change expected from the Bank of Canada, but generally speaking, I think we're going to get a dovish rhetoric, because you've had sort of economic data out of Canada in the last sort of round of data, which is pretty sort of tepid, pretty negative, and you've got inflation dropping back to 1.3% from 1.5%. You've got growth, which is not all that great. You've got retail sales again, which have been disappointing. So I think ultimately we're going to see again another dovish rhetoric from the Bank of Canada today, and it's likely to be possibly a little bit of a retracement on the Canadian dollar. I will talk about the Canadian dollar, but I think it's pretty much range bound now. In terms of the European Central Bank, that's tomorrow. That is the big one. I'm going to focus on this in a little bit, but generally speaking, as with a lot of these banks at the moment, no change expected. But I think Draghi is going to talk up the prospect of further easing being pretty dovish. Bank of England next week. Again, data improvements. Interestingly, data improvements that we've seen in the UK in the last month. Big bounce back in the PMIs, huge bounce back in the PMIs, I should say, and also retail sales coming in stronger than expected. The sort of weakness of sterling is really beginning to sort of have an impact on companies, and it doesn't look as though the Brexit slowdown is hitting quite yet. However, I think going forward, the impact on costs for these companies it could well be going up due to the fact that the input costs from getting their sort of input materials from abroad would be impacted by that sterling weakness. So that could have an impact going forward certainly on inflation, but also on potentially on growth as well. In terms of the Swiss National Bank, again, next week, no expectation of a change there. The Bank of Japan and the Fed Reserve on in 2 weeks' time at the big data, the big monetary announcements. Now, the Bank of Japan is an interesting one. The expectation is that, well, we've been told that they're going to have a comprehensive reassessment of monetary policy. Now, Kuruda has already come out with and said that we're not to expect any sort of coming or sort of loose. What's the term I should be looking for? We're not to expect any sort of foot coming off the pedal in terms of monetary easing. I think they're going to continue to push forward with that. Exactly what that means and what they can actually get through the committee is probably going to be a big issue, because just hearing overnight today that the committee could well be split in terms of what they could do going forward. So that might mean that the Bank of Japan again underwhelms on its measures on the 21st of September. It doesn't look as though they're going to be doing much with the deposit rate. Kuruda has said that banks are being impacted on their profit line through the negative deposits, negative deposit rate. So what could they do? Again, sort of extending asset purchases, ETF purchases, etc., etc. But they've only just done a round of ETF purchase extensions, so it's difficult to really know what they can do other than helicopter money. And that is obviously the big one that everyone's looking out for. And the Fed on the 21st of September, again, as I've just discussed, I do not believe that the Fed will be hiking on the 21st of September. So what we will see, I think, is a lot of volatility through these meetings this month, because these meetings are all sort of key major meetings, actually, where you could possibly get some sort of action. Certainly the European Central Bank is not expected to, but I mean, say for example the ECB look at the data and think, wow, the Eurozone is still not in a position of which it's sort of moving towards its sort of monetary policy goals at all. Might need a bit of extra push. Bank of England, again, not in any way likely to now, with considering the data improvements, but it'll be interesting to see what Mark Carney comes out in the statement. And obviously the Bank of Japan and the Fed are sort of right on the knife edge in terms of what they could do still. So I think there'll be a whole lot of volatility in the next couple of weeks. So moving on to the ECB, well, we've got, as I said, no expectation of any sort of moves on interest rates, and therefore the likelihood is that the volatility will be seen through the press conference tomorrow. So you've got the announcement at 12:45 UK time. The press conference starts at 1:30, and I think the press conference is going to be where we see the volatility. Now, the pressure is mounting on Mario Draghi, I believe. You look at this data that I've seen here: unemployment creeping back higher, inflation dropping back to 0.2%, and also dropping on the core. Eurozone composite PMI. Now, this is the interesting one, but basically that's the lowest since January 2015. 52.9, and the data in the last couple of months has been sort of a bit underwhelming, really. And Q2 GDP growth slowed to just 0.3%. And in terms of the PMI run rate, that suggests that Q3 could be maybe 0.2% of GDP growth. So that would suggest that not only is growth, inflation, and unemployment all going in the wrong direction, it doesn't look as though the sort of quantitative easing program is doing a great deal. You could argue that Eurozone bank lending is marginally increasing and it is slightly improving. However, in terms of the headline figures, you're not really seeing too much of a traction. And it seems to be that the economy is not really moving forward. So you've got the star forecasts that are being updated today. I think ultimately it probably is a little bit too soon after the recent measures that put through from corporate bonds being purchased, and that may well sort of mean that Draghi holds off, and also the improvement in the UK economy, or prospects of the UK economy, probably not falling back into recession, have probably sort of slightly sort of taken the edge off any sort of Brexit decision or Brexit impact on the Eurozone. So maybe they will hold off again today, and that subsequently means what will they talk about? Well, sorry, tomorrow. What will they talk about? Well, going forward, a deposit rate cut. Would we get another deposit rate cut down from negative minus 0.4? Again, it's similar to the Bank of Japan, really. There's little appetite for this, and there are still issues with bank margins and profitability. Same sort of issues with Japanese banks, and obviously the banks in the European Union or the Eurozone banks are still under huge pressure, and you've sort of got a lot of sort of headlines that come out with the problems that the banks are going through. Draghi doesn't really want to put too much further pressure on those banks, I don't imagine, by cutting the deposit rate any further and impacting on their sort of net interest margins in any greater detail. They could extend the QE program before March 2017. March 2017 is when it is scheduled to end at the moment. That's only sort of 6 months away now. So it's not exactly a long time before the end of the program, and obviously the questions being, what is the program achieving at the moment? Well, I mean, if the program's not really doing a great deal, then sort of maybe extending it is a debatable process in itself. But you could increase the purchases from 80 billion a month, 80 billion euros a month, as well as extending the program beyond March 2017. I think the likelihood is we're going to see some sort of action again in December. December is the next time we get the staff forecasts for the Eurozone ECB, and I think that is probably going to be the next time we get some sort of significant policy action. But there's also sort of increasing talk of the ECB possibly sort of changing the rules on its asset purchases. I mean, you've got these capital key rules, which basically means that the ECB just ends up having to buy German debt because German debt and French debt, but German debt especially because of the size of the economy. So it's done on GDP size, buys bonds are proportionate to GDP. Changing the capital key rules could mean that it could spread out the bonds more efficiently through the Eurozone. That is one argument possibly on the table. Removing of the floor of the 0.4% bond eligibility. Basically, the ECB does not buy bonds below the deposit rate limit of 0.4% negative. But that means that there's an incredible shortage at the moment of German paper to buy. 75% of German bonds are negative, and almost 60% are yielding below 0.4% negative. So the supply of bonds for the ECB to buy is very limited. And also there is a prospect of increasing the issuer limits. At the moment, only 33% of any one bond can be purchased. They could increase that by sort of improving that to 50% to increase the sort of pool of bonds. I mean, these are all sort of rule changes that they could do. Again, there's a debate going on as to whether they will do or not, but certainly it is the shortage of bonds in that the ECB can buy means that the program at the moment is pretty tricky to sort of implement. So lots that could be done, but again, I don't think this is going to happen this month. I think it's sort of going forward is when we're going to see that coming through. So in terms of what we're going to look out for in the coming sort of days and almost weeks, I suppose. I think obviously trading euro in front of the ECB isn't. I don't imagine there's going to be a great deal of direction now. That's sort of generally what we see in front of these key central bank decisions. But I think in the wake of the ECB, generally throughout 2016, the euro has strengthened on the monetary policy decisions or the monetary policy meetings of the ECB. And also, you could argue that you look across the majors really on the monetary policy decisions, even on sort of issues and events when you've had rate cuts, you've had quite often seen the currency strengthening, where sort of the Aussie dollar, for example, is a prime one, where you had the Aussie dollar strengthening despite the fact that you had a rate cut. So you could argue that why is that happening? Well, you could argue that it's the market questioning how much the banks can actually do, the central banks can actually do to sort of impact on the markets. But it is very interesting that this continues to happen, and generally, as I said, the euro tends to sort of appreciate in the wake of monetary policy decisions by the ECB. And also, not only that, you look at the data, the likelihood is that the ECB is going to be dovish tomorrow, although again, I'm not expected to do anything in terms of sort of solid monetary policy easing, but still, that could well drive if the market to be marginally disappointed by the fact that they could start to sort of buy the euro again, interestingly. But not only that, you've had dollar negativity throughout, and it certainly doesn't look as though that the Fed's going to be hiking in September or anytime soon, certainly not before December. So that again could strengthen the euro. In terms of trading in terms of trading the euro, the UK data has been increasingly positive, and it is creating a lot of volatility for cable, especially, but also sterling against the euro as well has significantly fallen away in recent couple of weeks. And it gives the Bank of England a bit of an issue next week. I think you've got, interestingly enough, maybe this afternoon, you're going to get a bit of a hint, possibly through Mark Carney. Mark Carney is due before the Treasury Select Committee to sort of talk through the latest monetary policy from the Bank of England, and maybe that will sort of give you a bit of an idea of what they're going to do going forward, because obviously the recent data, as I said, for the UK has been strong. And it'll be interesting to see if they give any sort of hints today. Again, trading Canadian dollar, the Bank of Canada is important tomorrow, but also the IV PMI, which is also at 3 o'clock tomorrow, and Canadian unemployment is on Friday. All these different aspects I think could well have an impact on the Canadian dollar, but also the movement on the oil price, because the Canadian dollar is or oil is a very significant sort of commodity in terms of production for the Canadian economy, and it does have an impact in the fact that the movement on WTI has a positive correlation with Canadian dollar. So watch out for the movement on oil. Oil has been sort of rallying in the last few days, and again, I think today. So that would be strength for the Canadian dollar. But again, arguably, if the Bank of Canada gives it sort of a dovish lean in its update tomorrow, perhaps the Canadian dollar will lose a bit of its bits of momentum. In terms of trading gold and silver, negative correlation to the dollar is back in play. So the dollar related data out of the US has had an impact on the gold and silver price. Big rallies in the last few days. You've had negativity on the ISM data, then the non-farm payrolls, and now the ISM non-manufacturing data. And all of this is putting dollar weakness and, generally speaking, precious metal strength. In terms of trading risk, Aussie and Kiwi currencies would be the focus there. Look out for the Chinese trade data and inflation. And a chart of the day that I did this morning on my morning report was the FTSE 100, and I'm sort of talking about how the fact that FTSE could be set to underperform if sterling continues to sort of rally, and I'd be looking out for underperformance against the DAX as a sort of a major mover there. But very, very strong underperformance FTSE had yesterday as sterling rallied sharply. And here's sort of a little bit more of the key data that we need to look out for. As I said, Bank of Canada on today, this afternoon. Also the Fed Beige Book this afternoon, 7 o'clock UK time. I think that could be an interesting one because, again, it will be sort of pointing out what the Fed is looking out for in terms of its economic outlook, really. And I think the Beige Book is a very interesting tool and can give some insights into sort of monetary policy potential. I know we've had the rhetoric out from all the Fed members, which is sort of mildly leaning hawkishly. Certainly the speeches at Jackson Hole from Janet Yellen, Stanley Fischer, were all sort of leaning mildly towards hawkish, but again, not anywhere near sort of confirmation of what they're going to do. So the fact that there is ambiguity in the Fed rhetoric, I think, will be interesting. But going forward, I think that September is out and December is possibly on the cards. But Fed Beige Book this afternoon, 7 o'clock, could well have an impact. And watch out for Canadian dollar, obviously, on the Bank of Canada, and US dollar on the back of the Fed Beige Book. Tomorrow, we've got China trade balance, imports and exports. Now, again, the expectation is for the China trade balance or the imports and exports to continue to decline, but at a lessening rate. So is that sort of suggesting that possibly the slowdown is not as strong as it has been previously? Key event of the day is clearly the Ecb Monetary Policy. As I said, no change expected, but Draghi expected to be sort of fairly dovish, I think, in his approach, certainly in light of the recent data. EIA oil inventories, I think this is an increasingly important number, certainly for the volatility aspect of oil. There are two different aspects here: the oil inventories, the crude oil stocks, and also the gasoline stocks. These are two factors the market is looking at. And the inventory build that we've seen in recent weeks is a key driver there. And also looking out for the EIA oil production numbers from the States, which seem to be now on an increasing path. And with all that, there's a lot of risk sort of drivers in there. So risk currencies, I think, could be involved. Aussie dollar, Kiwi dollar, euro, obviously on the ECB, and the DAX on the ECB, and obviously the oil price as well. And China inflation on Friday, it didn't have too much of an impact last month, but certainly inflation is expected to fall on CPI, which would suggest that perhaps the People's Bank of China might need to be pushed towards some sort of further easing measures, but also the PPI is actually improving, lessening in its deflation. So it's a bit of a sort of a mixed potential there, but again, the risk currencies tend to react strongly to the China data, and anything of a global growth related play. You'd be looking at the likes of oil, again, possibly the DAX in terms of your equities being impacted. So with that in mind, why don't we have a look at, sorry, let me just get rid of these two in the background here. They shouldn't be there. And that. Let's have a look at some of the charts. Now, I'm going to start with the euro. So the technicals on the euro have been pretty mixed of late. You've sort of been sliding generally, but I think sliding back towards this big long-term trend channel, sorry, long-term pivot line, 111 figure. 110 figure is also an aspect of that pivot line. If you just sort of zoom all the way back here to sort of 2015, you can see 111, 110.50 to 111 has been a consistent sort of turning point on these markets through months. So that is, in my opinion, still something that the market looks out for. It found support around that 10.50, bounced, found support around 11.20, so just above that 11 figure the other day, and bounced. And yesterday it had a very strong move on the back of the ISM non-manufacturing PMI disappointment. Ultimately, I don't think that does a huge amount. I mean, technically, yes, you'd argue the stochastics have turned higher, the MACD lines are turning higher, RSI by 50, but I think the ECB will have a big job in driving where this one moves next. So I think with that in mind, it could be a bit of a sort of a consolidation in front of the ECB, and ultimately today's candle pretty much reflects that. It doesn't really want to show too much further upside with that. Oh, let me just in terms of, let's have a look at the hourly. Actually think about it. Yeah, just basically a consolidation. You broke out above sort of that, I suppose arguably that is a resistance there that you broke through yesterday, 12.05, 12.10 area. And again, you sort of stalled around about that 12.33 mark, which is a historic level, which I can go back a lot further. So sort of 12, I mean, that was 12.50, but 12.33 was a historic pivot. So you've sort of just marginally holding on to that as we're trading at the moment, and I think this likelihood is that we're going to just hold on to these this move that strong ISM related candle that we saw yesterday. I think we're just holding on to that and just consolidating in front of the ECB. In terms of the outlook ahead of the ECB, well, it would suggest I think you're sort of mildly euro positive, trading above 111 figure, but again, nothing too significant. I think there'll be a bit of volatility, probably, but between 111 figure and maybe 113. It would be my guess. It might drop on Draghi being a bit dovish, but ultimately I think it'll probably find support and then rally again, because it doesn't really. I don't think ultimately the monetary policy of the eurozone, the European Central Bank will change too much. That's annoying. Let's try that again. So look at cable. Okay, question from AA. If dollar remains weak, euro can go up. I'd say so, yes. I'd say so, yes. The euro, as I said, technically is pretty positive actually still. Yes, you're trading underneath the resistance of that old uptrend channel, but I think ultimately what you saw in sort of early part of the year where the euro sort of skirted up again another old uptrend channel. You had two uptrend channels, and I think it could easily be that we're sort of in the process of building a third, and if that is the case, you'd sort of see the euro sort of possibly up towards 113, 114. Generally speaking, though, I think on a medium to longer term basis, 113, 114 is where the ECB starts to really try and jawbone and pull it lower. But yes, I think if dollar remains weak, which I think it will do in the next sort of month or so, I think we could well see the euro sort of trading higher. But again, this is a big, broad trend channel, big, broad sort of trading range in the last sort of 2 years or 21 months, I should say. And again, I don't think it's going to be breaking that anytime soon. I think you're going to be trading around that channel. So cable is rallying quite strongly, or has been in the last few days. Bit off today, 60 odd ticks to the downside. But again, it'll be interesting to see what happens with cable, because I think that cable's sort of in a bit of a trading range, really. I don't think cable is going to be doing too much. So get rid of that. I don't know what that is. I don't think it's going to be breaking out to the upside. I think it has a little bit of upside potential still left. 34.80 is the rally high of July, and then 35.35 was sort of post-Brexit rebound high. I think this there is a little bit further upside potential, but not much in my opinion. I think these rallies tend to sort of roll over around the sort of 60s, mid-60s area on cable. Certainly have done, as you can see here. So it'll be interesting to see what happens now in terms of the near term, because I think that it could be that the near term outlook drives that range. Because something that I drew in on my charts today, actually, let me zoom out slightly. Something that I did on my wrong one. Sorry, wrong bottom. So you've got an uptrend there that you're actually now breaking down, but you are back to a band of support around sort of 33.50, 33.60, 33.70. Seems to be a band of breakout support level around that sort of level. These highs here from the last few days. That is basically where the support will start to come in. And it has done. Also supported at the rising 55-hour moving average, interestingly enough, as well. So if cable can hold on to this support 33.50 area, I think it could be quite positive, because you sort of look at the sort of latest breakout, and also the fact that you've got 32.50 again was supportive, but also a sort of basis of resistance, old resistance, and old resistance becomes new support. So 32.50 and 33.50, I think there's a 100 tick band of support there that will be very interesting to see what happens. These momentum indicators just unwound slightly, you'd argue, more on the hourly RSI than perhaps you wanted. So perhaps that is going to put more pressure to the downside, but in terms of this little corrective move. But again, I'll be very interested to see if this support around 33.50 holds near term. If the MACD line starts going negative, I think that we could be in for more of a correction and a drop back towards sort of 32.50 area. But at the moment, cable is sort of still in this upward momentum phase, and I don't necessarily think this trading today has yet sort of broken that, but it is testing it. Dollar yen falling away, and on this chart you can see this downtrend channel. It's been in place for throughout 2016. You could argue, I'm a little bit inaccurate with that trend channel. Top sort of link the highs. You marginally broke it, not by much, but you would argue that it's still, I think, intact, and falling away. And not only that, look at these momentum sell signals, stochastics, July, May, April, all of them giving top corrective signals, and January actually really strong sell signals. All of them work to treat, and I think we've just had our latest one, so that's not great for Japanese, for dollar yen. The RSI around 60 again tends to be where 60, 62 area tends to be where those highs are sort of posted. So this is almost classic trend channel trading here. So that is very interesting that we're seeing that. Japanese yen on the hourly chart, again, we've seen a mild sort of bounce overnight, 101.18 up towards 101.50, sort of 30 odd ticks. I don't necessarily think it will be anything sustainable. Seems to be a resistance that starts to sort of come in around that 101.70 area, arguably up towards 102.40, but I think around 102 big figure, I think that's a fairly sort of decent area where you can start to think about your next shorting positions, because basically what we've seen is these hourly MACD crossing higher, stochastics crossing higher, RSI higher, but ultimately we're now, I think, far more negatively configured. RSI failing at 60 yesterday. I think anything around the sort of 40-50 area, possibly mid 40s, I think could well be where we see the next sort of selling opportunity, and that could well be seen around 102 big figure. So that's dollar yen. Aussie dollar. Interesting, because it had a really strong run yesterday, slightly corrective today, on the back of a mild miss on the GDP numbers. But yesterday's move came on the back of the improved current account figure. Current account deficit was slightly reduced. Slightly lower than expectations. And the the Reserve Bank of Australia didn't do anything on rates. Fairly much sort of this meeting passed us by. So there's not a huge impact that we've seen there. But again, ultimately, the Aussie rallied pretty strongly, didn't it, on the back of that meeting, and also the the current account deficit numbers. Technically, you're in an upward phase. You've got these stochastics accelerating away, and that tends to go for a two or so weeks. So we've got possibility of further upside move. Uptrend intact, fairly much. Moving averages supportive. You're trading above all the moving averages, so that's strong. It looks like we're sort of pulling towards likelihood of a retest of these highs of the August moves. So that's 75.50 area, sorry, 77.50 area. It looks like there is slightly more upside potential, but as I said, you're still in a positive outlook. You've still got the RSI, which sort of bottomed around 40. If it pushed above 60 again, that would say that we're confirmed in more of a positive outlook. MACD lines coming back towards neutral, sort of trying to turn up. Again, stochastics higher, so it's all pretty positive. And the reaction that we've had on the Aussie today, in fact, because the Aussie was initially sort of under a little bit of pressure, but you would argue, looking back on this chart, anything that sort of unwinds the overbought momentum is probably seen as a chance to buy, and that seems to have been the case with this around 50, so the late 40s towards 50 on the hourly RSI is where that sort of started to turn up. The stochastics are turning up, the MACD lines are starting to bottom out. It already is looking like a positive move. So this sort of breakout level around that sort of arguably pivot line, 76.55. It's a pretty good pivot line, actually. It's not too bad at all. Slightly there, but subsequently resistance slightly through that, but then again resistance and broke through that and found a basis of support in that as well. So 76.50 area seems to be a basis of support now, and it's pushed up higher from there today. So I think that that's a fairly reasonable level to start thinking about sort of new long positions. This is probably near term though. As I said, you could argue that possibly the upside potential is relatively limited with these big overhead resistance levels in place. And yes. Oh, sorry, I didn't see your. Could there be a short squeeze for? Can there be a short squeeze for sterling? Well, sterling's going up, so sterling's being bought at the moment. So I'm not sure about it being a short squeeze in terms of the fact that it's been going on for quite a while, and it's been fairly orderly as well on the sterling rally, and it's been coming on a string of positive data points. I mean, you could argue, just going back to cable, that sterling has actually been rallying since mid-August, really, since that low of mid-August. The nice sort of pivot band around 30.60, use that as the basis of support to push higher. Ultimately, I think sterling is not going to break out, as I said, and I think that there is still a lot of volatility, I think, to play out from this Brexit decision. And I think there's likelihood is that we will see some further weakness, as chances are you're going to get some. Politically, for the PMI data, for example, for the UK, I don't think that's going to be remaining strong. I think that's going to be fluctuating around, and I think the cost aspect of the weaker sterling on input costs could have a drag effect ultimately. Right, Karim, let's have a look at Kiwi dollar. NZD equals. What a breakout that is. What a breakout. Goes back away. 74 big figure I've got in there. I mean, it's sort of an element of being a bit of a pivot line back in 2015, but what a breakout. You would argue that this is a really strong move on the Kiwi. I mean, I imagine you could probably fit in some sort of trend channel. I haven't drawn this in previously. And you're not a million miles off the top of that trend channel now. So that would be a slight concern. RSI up over 70. That doesn't happen too often. And when it does, you start to see a sort of a bit of a drift, in the very least, a corrective move. So you've seen a really strong move on this Kiwi dollar, and it certainly looks like it's a strong breakout. But the bulls need to now sort of start to form support. You'd be looking out for sort of 73 figure sort of breakout levels between 73 figure 70 sort of 75 sorry, 74.75. So you'd say there's sort of 80 or so ticks worth of support now for the Kiwi dollar. But any sort of unwinding move tends to be bought into on the Kiwi, certainly in the last few weeks as well, with the momentum indicators so positive. So just zooming in here, I could imagine you could probably do even more interesting. No, not as good as I thought it was going to be. But just, yeah, it's not as good as I thought it was going to be, that one. Okay, let's get rid of that. That's not right. Don't like that. But yeah, really strong breakout, and all that old resistance around 73 figure becomes now supportive on a correction on the unwinding move. So it looks strong, really strong. It'd be very interesting to see whether it can break out through that uptrend channel. Your momentum on the hourly chart, again, there's no real reason to think it's not going to continue to go higher. 74 figure supportive on a little bit of a retreat this morning. Candles all strong. A nice bullish engulfing candle to really get us going there on the move this morning. Stretched on the near-term basis. I'd wait for your entry points. You'd say on a conservative basis, this 55-hour moving average has become a base of support, and that's back at 73.60. So it's over 100 ticks away from here we are. But you look at the momentum, generally speaking, you'd say that's pretty stretched. But pretty stretched momentum doesn't necessarily mean it's not going to continue to go. It just means that perhaps the upside potential could become a little bit limited in the immediate term. And certainly the RSI at 83, that doesn't happen often at all in this Kiwi chart. So you'd argue that that's probably not the best time to start chasing it higher, maybe wait for a better entry point. And around 74 figure, I think, is pretty decent at the moment. But I think it certainly does look very strong indeed. Okay, let's go on to gold, because I haven't got too much longer. Gold, again, working on the dollar weakness that we've had. That was the ISM manufacturing day today. That was the payrolls day, and this was ISM non-manufacturing. 3 out of 4 really strong candles that you've seen there have seen gold rally, and it's rallied hard down right to this downtrend. Tested that downtrend today, 1352 area. But not only that, you've got the 1357 rally highs of mid-August. Hit 1357, pretty much there or thereabouts on 4 separate occasions before sort of failing. So 1357 is clearly a level that the market is looking out for. And the gold price, I think, also needs, momentum-wise, needs to move back above 60, ideally to maintain this move. At the moment, it's consolidating. It's not really moving anywhere today. The ECB will have an impact, I think, on gold. A major central bank, if it certainly turns dovish or further dovish, I think that would have an impact on gold, and that would be supportive for gold. Technically, stochastics are strong. MACD line is starting to turn up, but it needs to break this downtrend. It needs to break through 1357, and ultimately, I'm still bullish on gold long term. Following on from that breakout above 1306, that was a really strong breakout. I'll show you historically why. Because that was a big rally high of 2015, rally high 2016, and then bang, you broke it, and you're finding support above it. So that is a really strong breakout longer term. And there's no real reason why gold can't continue higher, with central banks remaining loose and the Fed not tightening as anywhere near as fast as possibly it could have done. I think that ultimately will drive gold higher in the long term. Now, near term, slightly stretched, slightly just drifting back a bit. You'd argue 1341, which was that this was the spike on Yellen's speech in Jackson Hole. 1341, and it was a little bit of a pivot near term through mid-August. So you'd argue 1341 is sort of a basis of support, but the main support comes in around 1330 again, which was an old sort of pivot area. these pivots aren't exact on gold, but certainly 1330 on gold is a strong support on the near to medium term basis, and I think a decent buy zone is now 1325 to 1330. But gold is certainly looking a little bit more positive now, but it needs to continue to move higher. And for now, it is just sort of coming up against a little bit of, oh, my charts, come on, a little bit of a corrective move today. But again, I don't necessarily think that's going to sort of do much. Let's just have a very quick look at oil. Annoyingly, my charts sort of were screwed on Monday from that Labor Day, but certainly oil is sort of benefited on the back of this suggestion that Russia and Saudi Arabia are going to cooperate on oil production. Will it happen? Open for debate massively. I think you're going to get a lot of volatility in front of this Algerian meeting, and I think ultimately we could see sort of choppy moves on oil. I mean, these countries are all saying 50 to 60 is where they're comfortable with oil. So I mean, my expectation would be that 50 would therefore be a bit of a resistance. So I don't necessarily think it's going to get too much further. You might see some chop around sort of between 40 and 50, I think, in the next month. But I don't think it's going to go significantly higher. But you'll get a lot of volatility around on the oil price. But for now, technically, it's pretty choppy, pretty messy. Rallying on the near-term basis, unwinding that move that we had early last week, and it could well continue. That we see the oil price sort of remaining choppy. In terms of your resistance, this rally high 14,650 on Monday, that was actually an old support and a bit of a pivot line as well. So 46.50 seems to be your resistance in place on WTI, Brent. Sorry, WTI. Right, so in terms of what our key events is going to be the ECB this week, monetary policy press conference this week. What's going to happen? I don't think we're going to get a change of rates, but I think Draghi will be dovish, and I think he will talk about future action rather than actually doing anything this time out. What could that future action be? We're talking sort of a possible extension of the easing program to from March 2017. Possible increase of the purchase amounts. But also there could be a possible movement on the sort of factors that drive how the ECB implements the quantitative easing policy. In terms of your impacts on markets, clearly the euro is going to be a big mover. The DAX is also going to be a big mover, and eurozone bond yields as well. Also think about gold, I think, because gold will be sort of driven on the back of easier monetary policy is positive for gold, and other FX majors certainly such as the dollar, I think will be key. So with that in mind, I've got all my research on the Handtech website. Go to our website and click research to see it. You can follow me on Twitter. You can join our LinkedIn traders group, Forex Traders Talk, and I look forward to speaking to you all again next month. And with that, I will leave you with the disclaimer, and I will see you soon. Thank you.